And it's easier to handle this kind of thing because as against entering someone's shop and sitting down and going, yeah, here now there's no yeah, just this. You enter someone's place, even if I water, like why you come and take space, you feel like that, like this is this space. Now if person look you, no be wetin they look you, you dey feel like that when you but una gist, una gist.
All right, guys. Good evening. So, today we're going to be continuing our discussion. All right. So yesterday we spoke about looking into imbalances and examining what you have under them. So today we're going to continue the discussion um with Confluence. All right. So we're going to look at what is Confluence. What is Confluence? Confluence is basically um looking for one or more reasons to justify your trade. Just looking for one or more reasons to justify your trade. All right. So um, confluence, for example, could mean um, you have a certain interest rate on a currency pair, and that interest rate is telling you that to go higher. Okay. And on the charts, you have um, a bullish movement towards a significant area of liquidity. All right. So those two factors are adding together to point towards a bullish move on that pair or on that currency. So then you can look for um, places to buy from. All right. Also, that place you are buying from, you have to have confluence there as well. All right. So you can have um, another block with some liquidity sitting above it. Okay. Then an imbalance between the other block and the liquidity. And then you buy at the other block because it also induce some liquidity right before it. So those factors that come together are what you call confluence. Very simple, very short. Nothing to complicate it. All right. So, for example, when you go into your charts, you can just look for reasons to um back up your trade idea. All right. So, for example, now you are selling these assets. All right. So let me say the price action is somewhere around here. Okay. So price action is somewhere around here. I think I posted this thing on my status one time. In fact, that was when the price went below here, and I was saying that people should find an excuse to sell Euro AUD. Think I remember posting that on my status, and it later went and took out external liquidity out here, out here in the market. All right, so um, basically, you can say the complex for this trade is that first of all we have the market trending in a bearish direction. All right, the market is trending in a bearish direction. So it went ahead to mitigate this old high or this old low, a previous low. So we mitigated something there. All right, either around here or around here. So something was mitigated there. Okay, we have a minor break of structure here. All right, so at this point you can sell, but you're not yet sure that it will get below this. All right, but once it gets below this, you can see that you've had your break of market structure, your major break of market structure, and Once you target this, you are sure that the price will go and take out external liquidity, which is sitting down here. So all you can now do is to go down to whatever you have here and look for an area to trade from. All right, so you go down to your price action down here and look for an area to trade from. Okay, so probably um, your price mitigated a breaker block or mitigation block here. All right, so price mitigated something there, could be an imbalance or whatever. All right, so once you have another move down, you can now find um, your other block in here. Okay, so now you can see that the factors that are in that let me say you took a sell here. All right, took a sell at this point, and you put your stop loss at the behind of the other block. So your confluence could be that the price has number one, it has a liquidity sitting here. All right, so there's some liquidity, internal liquidity here that was induced. There's an order block inside there. Then is a long-term bearish trend, number three. Okay, then you have bearish momentum. You have bearish momentum, downside momentum. All right, and also you can look at this engulfing candle as a last confirmation for your trade as well. All right, so that's for people that trade candlestick confirmation, but I don't use that. I can just enter probably at the middle of the other block. Okay, so that will mean somewhere around there. Okay, somewhere around there for an entry. So um yeah, basically other block trend liquidity here, small imbalance in there as well. Um long-term downtrend, external a bit break of structure on the larger time frame or a bigger time frame. All these things are what come together to make what you call confluence. Confluence is basically um, a union of different factors that back up your trade. All right. So a union of different factors that back up your trade. So when you are trading, you want to trade what is high probability. Okay. So a trade that is high probability is one that it is on the side of the trend. It's on the side of the trend. Okay. So on the side of the trend, and it obeys other rules that you are following, and it's very very clean. It's very very clear. Some trades are not clean. Some trades are not clear like that. All right. So those kind of trades are lower probability than other ones like this one. All right. So yes, so that's all for conference. Our conference is just putting everything together and trying to um make some profit from the market. So all the factors that can come together to lend well to a particular trade idea. That is what we call confluence. All right. So now I want to look at weak and strong high. All right, weak and strong high. So basically, what I will characterize as a weak high or a weak swing. So weak and strong price swings. All right, a weak price swing is one that is just the opposite of a strong price swing, because there was a time I think some classes ago that we spoke about on what makes a proper break of market structure, that we said there will be a mitigation of an imbalance, or it is a swing high or low. So that means it has two other lows by the left and right, or it has two other highs by the left and right of it. So that makes a swing point in price and a strong area for a break of market structure. All right. So the weak lows are basically the opposite of that. So a weak low, a weak low doesn't mitigate previous ranges. Okay, it doesn't mitigate previous ranges. So let me say um, we have some sort of price movement. All right, we have price moving and just behaving normally, right? So we can now have something like this, and let me say it left something in here. It left like a void inside here. All right, it left a void in here. So there was some. Let me just Let me just delete this thing now. Draw it. Make a clearer picture. So we have price trending. We have price trending, and markets can form something like this. Okay, so that means that this one can act as a weak low because it doesn't mitigate this previous point in price. Okay, at least we want it to mitigate the previous range before it flies off. Okay, so if a low or a high or a swing point in general doesn't mitigate anything, okay, it is a weak low or it's a weak high. All right, so assuming you look into this imbalance now, I can find maybe another block inside there or something there. Yeah, I can call it strong. Okay, if it can obey other characteristic of a strong high or low. Okay, but in general, if it doesn't have anything in here and it doesn't come down to mitigate this place, I'll call that a weak low. All right, so and that way you can identify or spot a weak low or a weak swing is if it doesn't result in a break of market structure. Okay, so for example, we have something like this now, and price goes like this, and this guy doesn't cause a break of market structure and the price starts retracing. All right, there's a high probability that this guy might be induced before price continues higher. Okay, so the high probability that to be induced before price continues higher. All right, so there are certain scenarios that you expect something like this to happen. Okay, and we'll talk about that when we get to inducement. All right, so there's a particular point that price has to induce before it goes higher, up or down. It's either induce primary liquidity or secondary liquidity before it continues with the trend. All right, so if this low has not induced primary or secondary liquidity and it also fails to take out the previous high, okay, we'll refer to that as a weak low. So generally, when you're trading, try not to buy any swing point that doesn't lead to a break of market structure. Don't try not to buy them. All right. So if they lead to a break of market structure, you can buy them, but don't buy them as well if they have some sort of imbalance there and they do not properly mitigate the previous range. That still makes them weak as well. So it might be like this. It might move well. All right. So it moves well and it breaks market structure. All right. It breaks market structure. Okay. It breaks market structure. Something like this now. It breaks market structure, but it left an imbalance down here. Okay. So even if it broke structure like this, it is still a weak low. This is still a weak low, and I can expect price to come down below it to properly mitigate structure before going up. All right. So any any of your price points that doesn't correctly obey the rules of a strong high or a strong low, or a point that I said before that when price goes beyond it, it has resulted in a break of market structure, a proper break of market structure. Once any price swing doesn't fulfill all those conditions, then you can call it a weak low or a weak high. Okay, so we expect weak lows or weak highs to be induced, and we typically don't trade from them. A trade from them can actually make money, but it is not high probability. Okay, the high probability trades are the ones that you take from the proper points, the proper swing highs and swing lows. All right, so you might have price coming down to this week low and continue higher. That might happen. All right, but it's not a high probability trade. So more often than not, this kind of trade might fail. That is why you want to look for um swing highs and lows that mitigate previous structure. They mitigate previous structure. It doesn't leave an imbalance and continues flying. Okay, if it leaves an imbalance and continues flying, you can buy in the meantime, but be careful. Once you see something like a reversal on the top of the move, start getting weary and don't expect price to respect that point. Okay, so for example, if I'm bullish on something, okay, so it is moving like this, creates an imbalance over here, continues going, okay, continues to move, all right, continues to move up like this, okay. So each and every time I am buying all this dip, okay, each and every time I'm buying all these pullbacks, each and every time I'm buying all the pullbacks, all right? So once I see something like um a BMS or something like a reversal during the trend like this, okay, during the trend like this, okay, all these guys, I will not expect any of them. I will not expect price to do this to come like this. Respect any of these guys, okay? It will go ahead and take out this swing low that did not mitigate the previous swing, okay? To go ahead and take out this swing low that did not mitigate this previous swing. So I will not be interested in buying this thing anymore once I find a tiny reversal sign up here, okay? So all these can be good area to buy from, okay? But once it fails the first time, all of them are going to go in for it till we get to the swing, the weak high or the weak low. All right. So until we take that out before the price might continue higher. Okay. So be careful of a weak high or a weak low. Be careful of weighing weak swing points. Okay. So weak swing points, either they don't mitigate previous range, either they don't mitigate previous range, okay, or they don't cause a break in market structure. Okay, for example, now this guy, this guy did not cause a break in market structure. It went up, but didn't cause a break in market structure, and it had to fall down to mitigate something down here. So either they don't mitigate the range, or they don't cause a break in market structure. So one of the two, you'll find this characteristic of a swing high or a swing low. All right, so those are the two characteristics that would give to a weak swing or a weak price point. All right. So now I want to move on to the next thing, which is backtesting and intimacy. All right. So I don't know. Only some of you here have actually been active working on your own. All right. Well, it's all good, Sha. It is for your own good if you work or if you don't work. All right. So you might have wasted many hours. Me, if I've wasted, I won't say wasted, Sha. I'm giving to the world a grab. So I won't say wasted, but if you don't go ahead and backtest, like I said at the beginning of the training, you just wasted your efforts and your time, and you wasted mine as well. All right. So what you do with backtesting is that you want to check out um certain things in price and where they work well and where they don't work well. Okay. So um at which point is it high probability? What point is not high probability? But basically now, what I want to talk about is method that you can take with your backtesting. What kind of backtesting can you do? What should you be looking for when you are backtesting? All right. So the first way that you go about your backtesting is that you want to look at one or two things in particular. For example, now you are trying to test a strategy now. So your strategy could be like, okay, let me kind of draw a random high probability strategy. So let me say a strategy is that you want to sell or buy a trend. All right. And in that trend, they're looking for a range that has um, an imbalance, okay, has an imbalance, and also has internal liquidity that looks like a weak high, okay, or a weak low. All right, so this guy will look like a weak high for me because it does not mitigate previous range as there's an imbalance in here. All right, so now you can say that there's dollars or there's liquidity resting here. There's money here. My network bad. Now you can see that there's money right there. Okay, there's money there. Okay, so your strategy could be that, okay, let me say there is a sponsored candle up here. All right, then this is liquidity and this is my imbalance. Will it come in here, take out the liquidity and fill in the imbalance? All right, and go lower, or will it actually go into my sponsor candle before selling? All right, so You could test maybe these two strategies: selling at the imbalance or selling at the sponsor candle. All right. So you going into the chart to look at the scenarios that back up this trade. That is what you call backtesting. So you can check out maybe like if this thing happens 100 times on the charts, how many times does it hit the imbalance alone, and how many times does it hit the sponsor candle? In my experience, the sponsor candle is more high probability, but that might not be your experience if you go into the chart on your own. All right, so nobody is going to do all the work for you. All right, so this is an example. So you want to go into the charts to find out how many times it played out, okay, and how many times it did not play out. Also, you can also test somebody's strategy. So let me say um, there are there are strategies like the London Judas swing. All right, there's a Judas swing. There's the London Open strategy. There is New York Open strategy. There's the overlap strategy. There are many strategies for like day traders. You understand? So what I taught you here now are just like generic stuff. All right, the basic principles that guides everything in the market. All right, so stop runs, reversal, inducement, etc. Okay. So, but there are specific times of the day that correlate with certain types of price movement. So, you might go into the chart, try and observe it and see how it works. All right. So, the more you see how it works, the better you get at spotting it in your own trading, the better you get at anticipating such a setup. All right. That is why you have to go and backtest. So, um, intimacy. All right. So, backtesting will help you to train your eyes. So backtesting, the main thing that backtesting does is just to train your eyes. For example, at the end of the week, you can go into the chart, look at all the setups that formed on the pairs that you trade. All right, and how you could have taken advantage of it, and what you did wrong, what you didn't do wrong. All right. So after a backtest, you move on to put it in your journal. All right. A journal is just a book that you write down your lessons. Okay. So yeah, that's just basically it. Today's stuff. Nothing much, nothing complex. Just by testing a strategy, try and train your eyes to different things. All right. So the ones I've given you, I gave you guys assignments at the beginning part of this training. All right. So those are just to kind of make you guys used to the work that comes with it. Okay. But even as I gave you guys very little work, you guys still fumbled. All right. And keeping that attitude is not really going to help you succeed. You understand? So, um, trading successfully requires time, it requires dedication, it requires your energy, it requires your focus. You understand? So, you can't just give it half-heartedly. Trading is something that can replace the job you are running around for. Okay, so you come back home, you're tired, you cannot do this training, you I give one excuse or the other. Trading can replace your job permanently, and you are taking it lightly. Okay, so it's not something you take lightly, even though it will take some time. It might take you 1 year, it might take you 5 years, it might take you 15 years. Okay, but trading can easily retire you on the long run. Okay, if you are focused, within 2 years you can make something out of it. Okay, the way you guys are actually here, you are very lucky because you're learning the right things early on. All right, you're not like me or most other traders that just go around learning trash. Okay, gathering, paying for different things. Okay, etc. Just learning on YouTube, applying, wasting money, going back to the drawing board, wasting more money. All right. Even at this point, you're going to waste money as well. If you want to succeed, you're going to waste money too. Okay, but if you put in the work and you practice and you backtest and you look for your high probability setups, okay, so your high probability setup could look like something like this. Okay, so in a trend, you want to sell at order block, all right, a sponsor candle. The sponsor candle must not be at the beginning here. It might be somewhere here. You might find it here. Okay, could be a mitigation block, could be anything. Okay, so this might be how it looks. You might find equal highs in here. So that will be your target. Okay. Equal highs, equal lows, whatever. Internal liquidity share. You find it and you trade Once price takes out internal liquidity to give it some momentum to continue the move. All right. So this easy simple thing I just drew you here now, you can look at it in your chart and try and find out if it's bullshit or if it works. Okay. So yeah, that's just basically it. Yeah. Put in the work, put in the work, and I don't want to go deep into psychology yet because we've not got into that part. But psychology um, and risk management is also something very, very important. You have to include in your trading outside this technical stuff. But without the technical stuff, you will not even know what to apply in the first place. All right. So that is the use of the backtesting. Once your technicals are spot on, once you are good at reading the chart, the next thing you have to solve is the psychology part of it. Okay. So this thing I just drew here, you can see an example inside here. You can see an example inside here already. So you can see equal highs over here. You can see equal highs. All right. Equal highs were taken out and the price continued to trend. All right. So just simple stuff, sha. Backtest something. Look at the cost outline. I've taught you guys a lot. Look at all these things. Put it together. Okay, so you can put for this case now. You might see momentum here. Um, slower momentum on the upside. Internal liquidity imbalance coupled with or not coupled with a sponsor candle. All right. Most times, sha, coupled with another block there. Let me just refer to this as other block, not sponsor candle. Sponsor candle is just a valid order block. So everything is just order block, sha. So imbalance, order block, put all these things together. That's what we call confluence. All right. Combined with your trend and your higher time frame targets. Always have your target. Your target is the most important thing. Where will the price go to? The first and the most important thing to do is to know where will the price go to. I'll sound that again. The most important thing you have to know before you enter a trade is where will the price go to and why will it go there. Okay. So once you determine that your entry is secondary, you can enter anywhere as long as there is a 90% certainty that your price will get to that place because you have a strong reason why it should get there. Okay, so people say trading is 50-50, but if you master your setup, if you master your move, then it has reduced from 50-50, or it can increase from 50-50 to something like 70-30, 60-40, or 90% accuracy, in fact, on high probability trades. All right, so your entry is secondary. You might start trading now and then you be losing money, right? So most people lose money at the start, or you have a very very successful time like me. I blew when I started. I blew account once, but before I blew it, I made money. All right, and after blowing it, I made money again. All right, so you either lose for a long time or lose for a short time. For Shasha, you will lose as a beginner, and that's what I'm just trying to point out here. There will definitely be losses. All right, there will definitely be losses, and that is not something you should run away from. Don't be scared of them. They are part of the process. They are what will lead you to success. All right, so um um you might start losing, for example, and then you now find other traders on social media doing small stop loss, like maybe tiny stop loss like this, and then a very big target. All right, so this is very cool. All right, but like what I told you guys when we discovered sponsor candle, they are rare, maybe once in a month or a few times a year. All right, so don't be hooked upon this. You should be hooked upon finding a high probability setup and trading it and making money. All right, so your concern should not be the finest, the sexiest trading skills or the trading patterns. Your main motivation should be making money. All right. So I think time is fast spent by now, Sha. Basically, Sha, the lesson in this is that you guys need to go on your own and backtest. They're just like two people out of you guys that go and backtest these things and come to me with questions. All right. So once you backtest, you're going to have questions definitely. So if you don't have questions, that's when I know that you're not really working. You're not really working. Those that are working have questions every time. All right. So um That's just a little charge. We'll have more on the psychological part when we get towards the end of the training. All right. So backtesting is basically going to the chart and finding how many times a thing occurs and um, basically making your eyes to learn how to find it easily. All right. So that's what backtesting is. So with that, I will end today's session and I'll throw the floor open to you guys. I think I told you guys yesterday I have a class by 8:45 for the next 3 days. So I think it's down to 2 days now, today and tomorrow. Okay, today and tomorrow, yes. So by Monday, we should have regular length of classes and we should be done next week. I guess we might be done next week. But this inducement part might take a while. So yeah, if you have questions, ask your questions before we close today's session. Yeah.
When do we get to do like live session?
I don't know, like I wanted I don't know how to structure a chat. I was assuming that most people will not have time like that. So we can only do it during the night. But what we'll do is that you guys can drop uh okay, you guys cannot actually drop the time, but once we are done with the training, we will do our live sessions. All right, I'll do the live sessions probably during New York session. That is in the afternoon around 12 to 2 o'clock. All right, probably not that long, sure, but we'll just be looking at the chat and trying to find opportunities that we can trade. All right, so we'll have the live sessions. Anybody that can join will join. If you can't join, you watch a. I won't even have recordings for that because it just be um a waste of resources. You understand? If you want to join, you join it, and that will be the only opportunity. So yeah, once we are done, I'm trying to calculate it as within next week. Today is Saturday. Today is Saturday, so by next week Saturday, I want us to be done with all this. All right, so that we can move to this one. All right, so this is what will wrap up the training, and by the time we get here, we'll not be having night sessions again. We'll just be doing live sessions probably 2 days a week, Tuesday and Thursday. Tuesday and Thursdays, I won't really have time every day, but Tuesdays and Thursdays we'll have live sessions, but that will be after all these parts. So my target is next week, Monday, we start the live sessions, all right, but it might be later, depends on how fast we move through the rest of the program. So that's it.
Yeah, good evening, Cynthia.
Yeah.
So I have a question. Does time as in sections, New York section, Asia section, and London section, does it have anything to do with trading confluence, like using using it to one's advantage and others, and how could one use, if possible, how could one use them to his own advantage?
The advantage
And
is
how possible does it affect trading, once trading? I don't know if
mm,
it's possible
the way
for
it
it
affects
to affect
trading is that at this point, at this during this period, there is more volatility, and that's just it. So that means that during the London session or during the New York session, that's the time that you are most likely to experience an expansion in price or an impulse move. Okay. So for intraday traders, the volatility is very good. Okay, so you can just get in and get out within a few hours, unlike trading during a time that is not that volatile. For example, maybe around 12 a.m. Asian session. It's not that volatile because the Asian market doesn't have too much bearing on the common, most popular trading currency pairs like euro, pound, US dollar, etc. So all the only advantage is just it's there's usually volatility at that time, and that is the most likely time during the day that I might have an expansion. So The expansion might occur during different times, but that's the most likely time. But if you are trading as a swing trader or as a short-term trader, uh, that one does not concern you. You understand? So time and price, I think they just coincide. You understand? So some might say they're not really that related, but they coincide because a lot of people trade at certain times. So those certain times will bring in more volatility since more people are involved in the market. Okay, so it just helps you make money faster, or it just helps you push price around so that you can find a trade setup. Or how will I even put it? When you find a trade setup, you can time it at a particular time. Say, let me say between 1:30 or 12 o'clock to 2 o'clock New York session, we're likely to see an opportunity to enter the market. So you can just say, this is my office time. I will be on my chart by 12 and look for an opportunity till 2 or 2:30. If I don't find it, I get out, I'm done for the day. If I find it, I place my trade and I close it once it's my target. So the basic thing is just it doesn't really have, I won't say it is what controls price per se. I'm just going to say that it helps people with volatility. It helps inject volatility into the market, trading at certain periods of time, right? And it also helps you to structure your time appropriately. So if you're a day trader, you can say, I like trading during this period because this period has volatility on these certain pairs. Okay. But if you are leaving your trade overnight or something like that, the sessions don't really concern you. The sessions are just what is going to be pushing the market randomly, and in the end, it's either you hit your stop loss or it gets to your final target as an aggregate of whatever price movement has happened in several sessions in different days. So yeah, that's just basically it. Certain sessions give certain volatility. So yeah,
Okay, thank you, Sylvia. Please, answer a question. Do you use time session to trade?
I don't use time session.
And also, if we are doing backtesting, do we really have to be concerned about time section, like time section while doing the backtesting?
Like I said, it depends on what kind of trader you are. I'm not necessarily a day trader. Sometimes I day trade, but it depends on the setup. You understand? Most times I just trade from I leave trades overnight, so I'm not really concerned with the session. In fact, I won't really be very good at doing New York session blah 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 on the chart. I'll just be good at maybe pointing out generic things in the chart that you might look out for. And whenever it forms, it forms. All right. So it doesn't have to form at a particular time for me. Okay. So I don't really look at the sessions and things like that. So if you're a day trader, all these market sessions are important to you because you have to get in during the day and get out during another point of the day or during another time in the same day. So you have to know when the market will move the most so that you can enter at that time or enter before then and then take your profit after that time period. So as long as you are not a day trader, I don't think that you have much business with um the market sessions. But if you're a day trader, intraday trader, you can learn the market sessions. But it's just something that's going to complicate my own kind of trading. So I don't learn it, I don't use it, I just trade whatever I see. Yeah, basically.
Okay, thank you.
Yeah,
And also, the kind of pattern that you do earlier.
yeah,
So let someone assuming that okay, that uh, we are expecting a reversal to clear up some kind of liquidity, probably equal highs or some liquidity up and filling imbalance.
yes.
So if all that happens, like the filling of the imbalance and the clearing of the liquidity, if it's possible that it happens during that session,
Uh,
is it? And one is a kind of trader that like trading during New York session. Can
yeah.
that person take the trade as something that he has projected that okay, this is the kind of sector that I want to partake in? is it possible for that person to trade during that Asian session
If you are in the New York if you like trading in the New York session, that means that you cannot catch a trade in the Asian session automatically.
session?
You understand? So maybe probably if the price now hits here, okay, so then even though most times during the Asian session they usually take out the liquidity of the Asian session. So Asian session, maybe let's say it ranges like this, all right. So they might take out the liquidity up and down, all right, before continuing. So Asian session is just like liquidity engineering. So for most mainstream pairs, the price doesn't make any move of note during the Asian session. But if you have USD JPY, all these Asian pairs, all right, you might see something nice. Okay, but as long as you're in the New York session, you can never take a trade in the Asian session. So let me say it might start trending down. So you miss the initial move. All right. So something like this could now happen in the New York session. And this is the one you will take, not the initial one. Do you get?
Yes, thank you.
So your own setup will form later, not during the Asian session. Any other person? Okay, with that, I would close today's session. I wish you guys a good night's rest. Yeah, see you guys next week, Monday, 8 p.m. Good night.
Yes, thanks for the night.
Yeah.